Greetings from MWN.com. Dr.M.Wilson, formerly Vice Principal and Head of Department of Commerce, Scott Christian College, Nagercoil is delighted in presenting this session. Thank you. Please subscribe the channel MWN.com. Components of aggregate demand. Aggregate demand is the total amount of spending on domestic goods and services in an economy. Aggregate demand is determined by the overall collective spending by all economic sectors through the procurement of goods and services. These activities can be classified into four components. They are explained as follows. 1. Consumption spending. Consumer spending represents the demand by individuals and households within the economy. There are several factors determine consumer demand and spending. They are like price level, supply of goods, consumer incomes, and the level of taxation. 2. Investment spending. Investment spending represents businesses' investment to support current output and increase production capability. It includes spending the capital for fixed assets like equipment, plant, building, etc., and in working capital, like raw materials, and for day-to-day spending for production of goods and services. 3. Government spending. Government spending represents the demand produced by government programs, such as infrastructure spending and public goods. It means spending related to production of goods and services. 4. Net exports. Net exports represent the demand for foreign goods, as well as the foreign demand for domestic goods. It is calculated by subtracting the total value of a country's exports from the total value of all imports. If the exports are greater than the imports, then there will be net inflow of fund to the country. If the imports are greater than the exports, then there will be net outflow of fund from the country. Aggregate demand formula. The equation for aggregate demand adds the amount of consumer spending, investment spending, government spending, and the net of exports and imports. The formula is shown as follows. Aggregate demand equals C plus I plus G plus NX. C equals consumer spending on goods and services. I equals private investment and corporate spending on capital goods, factories, equipment, etc. G equals government spending on public goods and social services, infrastructure, Medicare, etc. NX equals net exports, exports minus imports. The four components of aggregate demand are well presented in this diagram. Factors determining aggregate demand. 1. Interest rates. Interest rates affect decisions made by consumers and businesses. Lower interest rates will lower the borrowing costs. This impacts in more borrowing to buy products like appliances, vehicles, and homes and companies. It means low interest rates will increase the capital spending and thereby increase the aggregate demand. Higher interest rates increase the cost of borrowing for consumers and companies. This impacts low spending tends or grow at a slower pace. Hence, high interest rates result in decrease in aggregate demand. 2. Income and wealth. Increase in household wealth increases the aggregate demand. Conversely, a decline in wealth usually leads to lower aggregate demand. If consumers are feeling good about the economy, they tend to spend more and save less. 3. Inflation expectations. If the consumers anticipate that inflation will increase or prices will rise, tend to make immediate purchases. It leads to rises in aggregate demand. But if consumers believe that prices will fall in the future, they will buy less now in anticipation of further fall in prices in future. This leads to decrease in aggregate demand. 4. Currency exchange rates. Decrease in the value of the US dollar, aggregate demand will increase. This is due to the fact that foreign goods will become more expensive and goods manufactured in the US will become cheaper for foreign markets. If the value of the dollar increases, foreign goods are cheaper and US goods become more expensive to foreign markets. Hence, aggregate demand will decrease.